Average rate of return. Average rate of return is also known as accounting rate of return. It is a return generated from the average funds invested in a project. It measures the profitability of the investment. The formula for calculating the average rate of return is average annual profit after tax and depreciation upon average investment. And how to find average investment? It is half initial cost plus installation cost minus salvage value plus salvage value plus additional working capital if given. Let's solve a question based on it. A project requires an initial outlay of Rs 20,000 and having a life of 5 years. It generates year-ending profit before depreciation and taxes of Rs 12,000, Rs 10,000, Rs 8,000, Rs 6,000 and 5,000. It is depreciated on straight line method. Tax rate is 35%. Compute ARR. So to compute ARR, we have to find out profit after tax. So in order to find out profit after tax, we have to deduct depreciation from profit before depreciation. Here we are left with profit before tax. Now we have to deduct tax from profit before tax and we will get profit after tax. In order to find out cash flow, you have to add depreciation to it. Then you will get the cash flow, amounts of cash flow. Now we will solve the question. So number of years are given as 5. Profit before depreciation 12,000 for the first year, 10,000 for second, 8,000 for third, 6,000 for fourth and 5,000 for the fifth year. Now we have to deduct the depreciation. So the depreciation will be calculated by dividing the 20,000 by 5. So 20,000 divided by 5, it is 4,000. For all the 5 years, it is 4,000. Now we have to deduct it from profit before depreciation and we are left with profit before tax. So 12,000 minus 4,000, 8,000 for the first year, 6,000 in the second year, 4,000 in the third, 2,000 in the fourth and 1,000 in the fifth year. Now we have to deduct tax. So the tax is given at the rate of 35%. So 8,000 into 35%, 2,800. 2,800 is the tax for the first year. For the second year, it will be 6,000 into 35%, that is 2,100. Third year, it will be 4,000 into 35%, 1,400. For the fourth, 2,000 into 35%, 700. And fifth, 1,000 into 35%, 350. So profit after tax and depreciation will be profit before tax minus tax. So 8,000 minus 2,800, 5,200. Second year it will be 6,000 minus 2,100, 3,900. For the third it will be 4,000 minus 1,400, 2,600. 2,000 minus 750, 1,250 for the fourth one and 650 is for the fifth year. Now using the formula, ARR is equals to average profit after tax and depreciation upon average investment into 100. So average profit is calculated by dividing the total profit by number of years. Here the total profit is 5,200 plus 3,900 plus 2,600 plus 1,250 plus 650. It is 13,600 upon 5. So 13,600 upon 5, 2720, 2,730. Now we have to find out average investment. So the formula for this is half bracket initial cost plus installation cost minus salvage value plus salvage value plus working capital. Here nothing is given to us, neither the salvage value nor working capital. So our average investment will be half of the investment cost, which is rupees 20,000. So the average investment will be 10,000. Now we have to directly put this into the formula. So average profit after tax and depreciation, it is 2730 upon average investment, which is 10,000 into 100. So 27.3% is the ARR. Moving on to the second question. A machine cost rupees 1,80,000 and is expected to produce profit after depreciation and tax during its useful life as follows. Years 1 to 5 are given and the amount is also given. The machine will have a scrap value of rupees 20,000 after its useful life of 5 years. Calculate ARR. Here profit after depreciation is already given, so directly using the formula, ARR is average profit after tax and depreciation upon average investment into 100. So average profit after tax and depreciation will be total profit upon number of years. Total profit is 15,000 plus 22,000 plus 30,000 plus 28,000 plus 20,000. It is 115,000. So 115,000 divided by number of years, it is 5. So total average profit is 23,000. Now we have to find out the average investment. So the formula for this is half initial cost plus installation minus salvage value bracket plus salvage value, and working capital is not given here, so I am not writing it. So half bracket initial cost, it is 1,80,000. Installation value is not given to us, minus salvage value. Salvage value is the scrap value of the machine, which is rupees 20,000, bracket close, plus salvage value 20,000. Half bracket 180 minus 20, it is 1,60,000 plus 20,000. This half is just for the terms within the bracket. So half into 1,60,000, it is 80,000 plus 20,000. So average investment is 1 lakh. Now ARR is average profit after tax and depreciation. It is 23,000 upon average investment, which is 1 lakh into 100. So it will be 23%. Here our ARR is 23%. So our question is complete.